tax-free savings accounts. They can be great vehicles for long-term savings, but how do you pick one from all the available options? In studio with us to explain this and what you need to consider before you open a tax-free savings account is Nerina Visser. She's a director at etfSA. Anthony Katakuzinos. Let me get this right. Katakuzinos, there we go. Retail Chief Operating Officer at Stanlib, and Finweek journalist Lamise Omarji. Thank you so much for making the time to join us. Anthony, I apologize, I'm going to get this right.
Pleasure.
Nerina, let me start with you. Just remind us, these tax-free savings that have come in was the beginning of this month. Just remind us what they are and what's available out there.
All right, so Section 12T of the Income Tax Act is the new legislation that was tabled, and under this legislation it allows individuals, South African individuals, to save up to 30,000 Rand per year into a savings or investment account that is suitably or demarcated as a tax-free product.
So, I'm just going to stop you there. Yes. We're just going to fix something on you so we can make sure everybody can hear you. But I'm going to move on to Anthony, who's going to pick up from where you left off in terms of what's available out there and where this exactly stems from.
Yeah, so I think it's an exciting new initiative from Treasury to encourage savings. So a lot of providers have come out with products, and I think which is fantastic because I think it offers choice to people. But I think the investor needs to be comfortable with a couple of things. He needs to be comfortable with the institution he's going to deal with, and if they have a relationship with one, well, stick to it if it has. Also see what they're investing for. So if it's a long-term investment, which I think this is aimed at, trying to encourage long-term savings, then I think you need to pick the appropriate assets under that. So for long-term investing of 5 to 10 years, why have deposits? Rather be looking at long-term growth assets, things like equity funds, balance funds and things like that for the long-term growth is my personal view, and it's the view of our organisation. So I think those are the type of criteria that you need to look at in terms of choosing where and what to invest in.
Mies, you wrote the story, so I'm sure you must have a couple of questions for our experts.
Yeah, one of the things that the financial advisors I spoke to were concerned about was that people wouldn't understand how the contributions really work because they can have multiple accounts at multiple service providers and they could incur a penalty of 40%. So what is your take on that in bringing the right information across to all these people inquiring about it?
I think we've fixed you now, Nerina, so let's have a look.
I think it is an incredibly important point, and the onus is on the investor or on the individual to make sure that they don't exceed their annual limit. The product or solution provider can't check that because there's no ways that I know if you come to me and open an account and you also go to Anthony and open an account, I would not know that. So it is up to the individual to ensure that they don't exceed the 30,000 contribution limit. So the value of your saving or investment product can increase over time, but it's about how much money are you contributing to it during any particular year. 30,000 Rand a year, there's a lifetime limit currently of 500,000, but that's going to take you, close to 17 years to get to that point. It's also likely that those amounts will be increased over time by government. So let's just focus on the 30,000 Rand for the first year of operation. You are allowed to withdraw money from that account. So you can take out of your 30,000 Rand, but you are not allowed to replace it in the same year. So if I've already made a contribution of 30,000 Rand, I withdraw 10,000 Rand during this first year of operation, I'm not allowed to contribute that 10,000 Rand back into my account again. So it doesn't reset and say you can do it again. So it does have the advantage that you can access your money, but you will lose that allowance in terms of contributions that you've made.
Anthony, what about fees? Every single time there's a product out there, first thing I look at is fees because I want to know how much I'm going to be paying. So how do these compare with what's out there?
Sure, I think fees play a big part in terms of how your investment grows, and I think the regulator has also put some guidelines to the industry around what they can and can't do. I think they're not too restrictive. One of the key things from an asset management point of view is they've said that no performance fees will be allowed in funds. So that's a key thing that we've looked at to make sure that none of our funds have performance fees that we're offering out there. But I think financial services companies have an obligation to fully disclose. I think clients need to understand that because if you're looking at long-term investing and staying in the product for the next 5, 10, 15 years, you want to make sure the fee structure is right. Our view is that we, in our savings product, is that we are not going to charge anything over and above the fee that you have in the fund, and that's all. Obviously, if you go through a financial advisor, he may charge an advice fee, but that is totally negotiable between the client and the intermediary, and to make sure that they're both getting fair value for the services they offer.
Louise?
Yeah, another concern is, what if I want to play it safe and stick to cash deposits only? I mean, should I consider actually choosing an investment instrument?
You know what, if I can maybe respond to that, it's absolutely fine to have just a savings product, and maybe this is a good point to differentiate between savings and investment products. Savings products typically would be what you would get with your bank, where you are earning a certain rate of interest on the deposit that you make. In an investment product, there is a yield. It could be a dividend or an interest that is payable, but there's also a capital component, and that capital component can increase or decrease. So you can have a capital gain or a capital loss. So it's very important to consider your risk appetite, the time horizon of your investment, just like you would in any other type of investment. But I do think it's important to consider what the purpose of this type of dispensation is. It really is about encouraging long-term savings. And the additional benefit that you as an investor will get by just having the tax-free component on the interest that you will be earning is really going to be quite marginal. And I do think that unless you're really already quite advanced in age and have got a fairly short-term investment horizon, I certainly would not recommend that one focuses on interest-only products, because I think you're losing out on a lot of the benefit that this can bring you, which is also to give you no capital gains tax on it, and full dividend and interest will be paid out, no withholding tax on those.
So Anthony, is definitely dependent on one's needs, but what about a financial advisor or a broker? Am I going to need one if I'm going to be investing in any one of these products?
I think it just depends on the individual and his circumstances. So in a situation where you haven't got a complicated financial situation, and you know that you just want to put away long-term savings, and you have a fair idea of what you're looking for, you can do it yourself. These aren't complicated products. You can go to your bank, you can go to an asset manager like Stanlib, and there are simple enough products to choose what you want for a short, medium, long term. However, I think also this product is an exciting product, because along with retirement annuities and other vehicles of savings, that this can be packaged into a holistic solution for a client in terms of their long-term savings. And you can use these different vehicles quite nicely together. And in that situation, you may want to have a financial advisor. So I don't think you must look at the 30,000 holistically on its own always. It may be part of your complete financial advice. And maybe 30,000 doesn't sound a lot, but we've worked out that over 15, 20 years, you'll probably put away, if you consistently save and meet the objective of what Treasury is trying to do in building up big lump sum savings, is that you'll put away 450,000, and in 15 years' time, effectively in a market-related product, it'll be worth 1.7, 1.8 million. That's quite a lot of money. And in terms of a long-term plan, it's something that you probably want to consider even with your financial advisor, if you're comfortable to do that.
Louise?
Yes, as an investment, like a long-term investment, what we've heard from Treasury is even that it can be used complementary to your retirement fund. So how do you suggest I could go about that if I'm looking into that as an investor?
Well, I think probably one of the biggest differences, the two biggest differences between retirement annuity tax-free savings or tax dispensations and what you've got in the tax-free savings environment, is that in retirement annuities, your contributions are also tax exempt. So you can actually claim that back from your normal taxable income, which means that's an additional saving. The downside of that is that your money is tied up until you're at least 55 years old. So there's a trade-off here. Retirement annuities are incredibly good investments, especially for somebody who is in a taxable or a tax-paying position. If you are not a taxpayer, so if you are a minor, or if you are not formally employed or earn less than the taxable income threshold, the tax-free savings account is a great way for you to get tax benefits or tax-free benefits without being in a position where you would normally have to be registered for tax and so on. So it presents a great opportunity, for example, for parents to save for their children. If you can open an account for a child, it doesn't have to be registered for tax, and you can make the 30,000 Rand contribution per child and build up the sort of money that Anthony was talking about, where at the end of that child's school life, suddenly you will have a very, very handy lump sum amount that will assist with either postgraduate or tertiary education or whatever else the child wants to do after school.
Maybe I can just add to that. I mean, just to complement, and you're absolutely correct in terms of how you describe the two. But if you look at an RA, as you said, you're stuck. Once it's you retire at 55, you can only get access from 55 onwards, and then you have to buy an annuity. Well, this is a complementary product where if you really ever need it, you can withdraw it and actually use it. So you don't have that lock-in situation. So therefore, they complement each other very nicely.
I'm going to have to leave it at that. Thank you so much to my guests this afternoon. That's all for this week's Finweek Money Matters. Thank you so much to our guests, Nerina Visser, she's a director at ETF South Africa, Anthony Katakuzinos, Retail Chief Operating Officer at Stanlib, I got it right, and Finweek journalist Lemise Omaji.